Welcome to Money is Freedom, a podcast exploring how finance and freedom connect in our lives. Created from thoughtful research and narrated by Notebook LM AI, this series brings you clear, meaningful insights into finance and beyond.
Welcome to episode 47, featuring the legendary venture capitalist Bill Gurley, from a conversation on the Invest Like the Best podcast. In this episode, Bill delivers his State of the Union on venture capital, exploring what he sees as potentially permanent shifts in the industry as we head into summer 2025. Let's dive in.
Okay, let's dive in. The landscape of venture capital and private markets. It feels like it's in a really complex state right now.
Yeah, complex is one word for it. Maybe even messy.
Messy, yeah. It's shifting in ways that touch pretty much everyone involved, founders, investors.
And frankly, anyone just curious about where tech and innovation are actually heading, it's definitely a system under pressure.
Understanding the forces at play feels crucial, doesn't it? Because they're influencing decisions, outcomes. It feels different.
Totally, in ways we haven't quite seen before.
Exactly. So welcome everyone to this deep dive. Today we're trying to unpack this current reality.
And we're leaning on a really insightful perspective, right? From Bill Gurley's recent chat on Invest Like the Best.
That's right. His take on where things stand, summer 2025, some really sharp observations.
So our mission here is basically to take the key market realities he highlighted.
See how they're interconnected, how they're bouncing off each other.
And figure out what this whole intricate picture means for you, whether you're building something, investing, or just trying to make sense of it all.
And we'll try to use that system-level thinking lens, see how the parts interact.
Right. And just to be clear, we're reporting on the observations shared, not judging any specific players or actions, just trying to understand the mechanics.
Yeah, grasping the dynamics. Okay, so where should we start? Peeling back the first layer.
Let's start with maybe the most visible trend, the money. The sheer scale of capital being raised.
Yes. The continued rise, maybe even the dramatic rise of the mega VC fund.
And we're not talking small steps here. The point was made, firms that maybe historically raised, say, $500 million
are now closing funds of $5 billion.
$5 billion, that's a tenfold increase in firepower for some really big names.
Wow. And this huge pile of cash isn't just for companies about to IPO anymore, is it?
No, not at all. The description was more like big check writing. And these checks, they're often going into companies that are still pretty young.
Like the example given was $300 million into an AI company that's only been around for a year.
Exactly. That feels very different from, traditional late stage.
And it's not just the established players getting bigger. We're seeing new entrants in this space too.
Absolutely, often with industry-specific funds. Names like Treaties, CO2, Altimeter, Thrive.
And the return of Massa. Right. That signals something significant.
It really does. It says something about where capital sees the big opportunities and the scale it's willing to play at. So, yeah, reality number one.
Yeah.
Just significantly more money managed by the big brands and these new entrants.
Okay, so huge surge of capital at the top. Then reality number two feels almost like the hangover from previous cycles.
Yeah, maybe where some of that past capital ended up. This idea of a large universe of zombie unicorns.
Zombie unicorns. It's a provocative label.
It is. But it points to this group, maybe around 1,000 private companies globally, valued over $1 billion.
1,000. Each supposedly worth over $1 billion. But maybe not generating much excitement anymore. That feels like a big overhang.
It really does. The estimates mentioned suggest they've collectively raised maybe $200 to $300 million each.
Okay, so maybe $300 billion in total primary capital.
Something like that.
Yeah.
And potentially tying up around $3 trillion of LP assets, the institutions investing in these funds.
$3 trillion tied up in companies whose last valuation might be from the peak market in 2021.
And that's the crux of it, right? Their current valuations are often questionable, investor interest seems low, and crucially, their growth rates have really slowed down.
But hang on, if the valuations are clearly out of date, why not just mark them down? Who benefits from keeping the old numbers?
That's a fascinating point that came up. The system itself, it kind of creates very little incentive for anyone to mark things down aggressively.
How so?
Well, the fund managers, the GPs, report the values. Auditors are there, yes, but there's still discretion. And sometimes the folks at the LPs, the institutions, might even have bonuses tied to paper marks.
So they don't want to see the values drop on paper either.
Could be a factor. And then there's the founder psychology.
Right, that's got to be tough. Seeing your paper net worth based on that peak valuation potentially gets slashed.
Exactly. It's human nature. Plus, there's a really important technical piece, the lick preference.
Okay, the lick preference. Break that down for us.
It's basically the total amount of primary capital the company raised. Simple terms. If the company sells, the investors often get that amount back first before founders and employees see anything from common stock.
So if they raise $300 million, the investors get the first $300 million from a sale.
Often, yes. So imagine the company's real current value is maybe only $400 million. After the investors take their $300 million preference, there's not much left for the team.
Ouch. So if the valuation drops too close to the amount raised, and exit becomes, well, pretty unattractive for the people who built it.
Precisely. That's a powerful disincentive to mark down the official valuation.
And many of these companies have enough cash left from the boom times to just keep going.
That's the observation. Enough cash to get near break even, so they can just sort of exist, maybe forever, without needing a new funding round that would force that valuation reckoning. Hence, the zombie tag.
And the whole zero interest rate period, ZRP, that fueled this, right?
Oh, absolutely.
Yeah.
ZRP basically postponed the usual correction cycle. It encouraged overfunding.
Companies took too much cash, tried to do too many things.
Yeah, built unsustainable revenue maybe. Then when rates went up and they had to cut back to survive like we saw in 22, 23, their growth just tanked.
So enough cash to survive, but not enough growth to be exciting. The zombie zone.
That's the essence of it.
Okay, so flood of capital coming in, backlog of companies stuck with old valuations.
Yeah.
Kept alive, but not really thriving. This has to lead somewhere, right? Reality 3, the exit markets are stalled.
Yes. Capital markets are largely stalled. Both IPOs and M&A have been really quiet since, 2021?
This is the part that feels so weird. The NASDAQ, it was up like 30% in 2024.
Yeah, strong public market.
But the IPO window felt slammed shut. That's historically unusual, isn't it?
It was highlighted as pretty much unprecedented in recent history. Something fundamental seems to have shifted there.
Why? What are the reasons given for the IPO stall?
Several things. Cost is a big one. Jay Ritter's data was cited, suggesting maybe a 33% total cost of capital for an IPO. That includes the fees, the underpricing.
33%, that's huge.
It's a lot. Plus, just the hassle and expense of being public, the scrutiny, compliance.
And maybe they just don't need to go public anymore.
That's a huge piece of it, and we'll definitely come back to that. The alternatives are getting better.
Okay, high cost, high hassle, private options exist. What about M&A? Why aren't the big tech companies just buying these guys?
Well, regulatory pressure often gets blamed. Alina Khan was mentioned, though she's gone now. But even so, the market hasn't really snapped back.
So it's more than just one person.
Seems like it. A big factor is probably the dynamic with the Mag 7, the huge tech players. They have mountains of cash.
But Washington and the EU are hesitant to approve big deals.
Exactly. So even if they want to buy, the deal certainty is low. Remember, the Wiz deal took over a year to close. That uncertainty makes M&A really difficult.
And the pricing doesn't help either, right? Those zombie unicorn valuations.
Right. If the exciting private companies are still priced based on 2021 peaks, it makes M&A much harder for buyers.
Okay, so if IPOs are tough and M&A is tough, what happens if a private company just gets incredibly successful, like really big?
That brings us to reality number 4, which is fascinating. The potential for trillion-dollar private companies.
$1 while still private. That feels fundamentally different from how things used to work.
It really does. But the examples given were SpaceX, OpenAI, already way up there, and Stripe, maybe on that trajectory too, reaching that kind of scale without needing a public listing.
That's a game changer. If you can get to $1 trillion privately, does that whole traditional need to go public for capital, for growth, for liquidity, does it still apply?
It raises massive questions, doesn't it, about the future role of public markets in scaling innovation.
Okay, so exits are stalled. Companies might stay private even if huge. Who's feeling the pinch from this lack of liquidity?
That leads straight to reality number 5. LP liquidity problems. This is becoming a really big deal.
LPs, the limited partners, the endowments, pension funds, the big institutions investing in VC and PE.
Exactly. the bedrock investors, because their fund managers aren't exiting companies via IPO or M&A like they used to.
The money they expected back isn't coming back on schedule.
Precisely. So they're facing cash crunches. They have obligations to meet, but the distributions aren't flowing.
Any specific examples of this stress?
Yeah, some pretty stark data points were shared. U.S. colleges and universities reportedly issued $12 billion in debt in just Q1 2025.
Debt just to meet their capital commitments to these private funds?
Seems so. That's a clear sign of strain.
Wow.
And it's hitting big names. Harvard apparently sold $1 billion in secondary stakes. And maybe the most telling, Yale looking to sell $6 billion in private equity.
Yale. But they basically invented the model, didn't they? The Yale model from David Swenson, pushing big allocations into illiquid assets like PE and VC.
That's the irony. The model worked brilliantly for Yale when they were pioneers. But the critical question raised was, what happens when everyone copies the Yale model?
If a huge chunk of global institutional capital is locked up in illiquid private markets, does it still work?
Or are we seeing the systemic consequences? The widespread liquidity constraints that happen when that strategy becomes the norm, not the exception.
So that very success, when adopted universally, might have created this new problem.
It certainly looks possible.
Yeah.
And the source suggested these LP liquidity issues driven by longer hold times, maybe taxes on endowments, university research cuts needing cash, potential secondary market sell-offs, tanking valuations. This pressure could be the thing that forces change.
Potential catalyst for the system to reset itself somehow.
Could be. It's a key pressure point to watch.
Okay, so just as this whole system seems to be gumming up zombie companies, stalled exits, LP pressure, boom, another massive force hits. Reality number 6, the AI wave.
Yeah, the timing was interesting. The observation was that this huge wave of AI excitement and investment landed right when the market was having that mini correction in 22-23.
The correction that was pushing companies towards profitability.
And maybe could have led to a fuller, healthier reset for the whole VC ecosystem.
But AI stopped it.
That's the argument. The perceived scale of the AI opportunity was just so massive, it sucked in enormous capital and basically stopped that broader market correction in its tracks.
And you see that in the valuations for AI companies, right?
Oh, absolutely. Sky high. We're talking 10x, 20x revenue multiples, sometimes much more, just huge belief.
And if traditional LPs are tapped out, where's this AI money coming from?
New sources are stepping up significantly. The Middle East was specifically mentioned as a major source of fresh capital flowing into these big AI deals. There's a powerful FOMO fear of missing out on this potential platform shift.
And it's not just hype, is it? There's real substance to the AI shift.
No, that was fully acknowledged. It's seen as a legitimate, maybe the biggest ever platform shift, like the internet or mobile.
And that belief reinforces the high valuations, network effects, compounding.
Yeah, it feeds that mindset of you can't overpay for the companies perceived to be the winners in this new paradigm.
But how do you even assess the quality of these early AI companies, especially the revenue?
That's a really crucial nuance that was highlighted. There's a real risk with businesses that are basically just reselling or wrapping foundational models.
They might have negative gross margins.
Potentially, yeah. And revenue can get counted multiple times as it flows up the stack. Yeah. It's hard to avoid this when you're in what was called an all-out war market.
Driven by
gavage tube funding. That was the term used.
Gavage tube, like force-feeding capital into these companies.
Exactly. Pushing huge sums in, forcing them into a high-burn, grab market share at all costs strategy. Unit economics kind of take a back seat, at least initially.
But AI isn't all market distortion. There's a positive side, too.
Definitely. The potential for incredibly fast learning, speeding up accomplishments, especially for self-learners, that was seen as revolutionary. And the excitement goes beyond just language models, robotics, healthcare applications too.
Okay, let's pull these threads together for a sec. We've got massive funds, zombie company overhang, stalled exits, LP liquidity pressure, then this AI boom sucking in even more capital, even from new places.
It's a lot happening at once.
So how does that new AI money work if traditional exits are blocked and some LPs are struggling? This brings us to the final key reality. Number 7.
Right. This new late-stage motion basically encouraging the best companies to stay private longer.
How does that work?
It was described as a major shift. Investors, like Thrive was mentioned as an example, are targeting these really successful, high-growth private companies.
The ones you'd normally expect to IPO soon.
Exactly. And they're offering them huge amounts of capital, but it's not just growth capital for the company.
They're also buying out existing shareholders. Founders, employees, early investors.
Yes, precisely. Providing the liquidity that an IPO normally would, but doing it all privately, it acts like a sort of a by appointment public market or private pink sheets.
Companies like Databricks, Stripe, they fit this mold, right? Questioning the need to go public.
They do. And the incentives for the company are strong. Avoid the hassle, the scrutiny, the quarterly reporting treadmill of being public.
Maintain more control, maybe make longer-term bets.
All of that. And for the investors putting up this late-stage private money.
What's in it for them?
Also very powerful incentives. In these private rounds, they can potentially get much bigger ownership stakes, maybe 30%, compared to the tiny 1-2% allocation they might fight for in a hot IPO.
So they get to capture more of the upside during those high-growth years.
Exactly. They get to hoard that growth phase that used to be more accessible to the public markets.
Locking it up privately.
Right. And then the follow-on effect, these investors go back to their own LPs, the institutions, and say, hey, the best companies aren't going public like they used to. If you want exposure to top-tier growth,
you have to invest in our private funds.
Precisely, which pulls even more capital into this private sphere away from the public markets.
Wow. Okay, so those are the 7 realities laid out. Mega funds, zombie backlog, stalled exits, huge private company potential, LP liquidity crunch, the AI boom disruption, and this new private liquidity mechanism.
Right.
It's intricate.
It's a really complex, interconnected system.
So what does it all mean? What are the implications of this whole setup? Is this system kind of broken?
Well, the observation made was that the U.S. capital market system, which has been such an engine, doesn't feel like it's functioning optimally right now.
Because of the high IPO costs and the M&A hurdles? Companies staying private?
Right. It means fewer opportunities for the general public to invest in growth early on. And it concentrates value and control in fewer private hands.
And that concentration, that shift to a less transparent private world, are there risks there?
Yeah, that concern was raised. I mean, sure, you have well-run large private companies like Stripe, but can you assume all 1,000+ unicorns will be?
Probably not.
And as more mainstream capital endowments, maybe even retirement funds eventually flows into these less transparent, higher fee private structures, it could create more room for, problems, obfuscation, maybe systemic issues later.
If the system isn't self-correcting easily, what could force a change? You mentioned the LP liquidity crunch earlier.
That seems like the most likely catalyst, that pressure point. Time is a huge factor, money locked up for 10, 15 years instead of 5-7.
Plus potential taxes, budget cuts demanding cash.
And the risk of the secondary market getting flooded if everyone tries to sell at once, potentially crashing those paper valuations. All that could force LPs to demand changes.
Or change how they allocate capital themselves.
Definitely. And maybe even sentiment shifts from big global investors.
Like that quote from Qatar's investment chief, expressing concern about PE valuations.
Exactly. If that kind of skepticism spreads among the big pools of global capital, that could really push fund managers to change their behavior.
Okay, so given all this, if you're operating inside this system right now, founder, GP, LP, what should you be thinking about? What are the takeaways?
For founders, especially in hot areas like AI, it was acknowledged that this gavage tube funding environment is tough. It almost forces you into that high burn, all or nothing strategy.
Even if it feels unnatural or unsustainable.
Yeah, it feels like you're kind of forced to play that specific game to compete for hyperscale. And that pressure often includes taking founder liquidity.
Which maybe feels like repeating some 0RP era mistakes.
Yeah.
Potentially crowding out smaller, maybe healthier outcomes.
That's the potential downside for the ecosystem, yeah. The game gets skewed towards only the massive wins.
But fundamentals have to matter eventually, right? Unit economics.
Absolutely. The source stressed that efficiency, operational skill, that pirate to Navy transition as you scale, it's critical, even if it feels like red tape in the moment.
And founders need to actually learn leadership. It's not automatic.
Right. You have to want to develop those skills. They're essential for managing the complexity. And especially with AI, designing for network effects, for systems that learn from data, that's key.
Okay. What are the fund managers? The GPs, what's their reality?
The math for them looks really challenging right now. Time is the enemy. If exits take 10, 15 years instead of 5, 7.
And there's ongoing dilution in the companies, say 3-6% a year.
The amount that initial investment needs to grow just to hit historical VC returns becomes incredibly high. It's tough math.
Described as super high-stakes poker.
Yeah, quite different from just giving standard company building advice. And there's maybe a subtle risk, too, that the board dynamic changes.
How so?
If you're pushing gavage tube funding, maybe you need to be the founder's best friend to win the deal, rather than providing that really tough, challenging feedback that can be so valuable.
Interesting point. Okay, and finally, the LPs, the institutions.
For them, awareness is job one. Really understanding these dynamics. Maybe even dabbling in the secondary market, buying or selling a bit just to get a real feel for it.
And questioning the old models.
Yeah, that critical reevaluation of the Yale model. Does it work the same when everyone's crowded into it? And maybe there's an opportunity for PE firms here actually finding value among those zombie unicorns.
Let's talk investment strategy. With AI being such a dominant consensus, how do you even think about investing? Is it just pick the AI winner?
That challenge was discussed. Investing against the crowd is hard when the crowd seems clearly right about the platform shift.
So maybe look beyond the core AI players.
Perhaps. Opportunities might exist in more traditional companies that can be significantly enhanced by AI, rather than just the ones building the base models. And there's that contrast between how big players like Microsoft integrate AI versus startups or even Google's internal dynamic.
And assessing AI company quality remains tricky.
Absolutely. Because of that early stage high burn dynamic, negative gross margins, maybe double counting revenue. It's hard to judge true quality until unit economics and optimization become the focus, which might be later.
And this isn't just a US story, right? The international angle.
Yeah, that was highlighted as really fascinating, especially China. The emergence of multiple deep-pocketed, high-quality open source AI models.
Prompted by things like DeepSeek, leading Alibaba, Baidu, others to open source their stuff.
Exactly. That could create this incredible dynamic of multiple models training each other, rapid experimentation, maybe more optionality than in the US system. That competition was seen as really noteworthy.
And beyond just large language models, other tech areas.
Yeah, brief mentions of excitement in non-LLM AI, robotics, healthcare, also hard tech, physical world stuff, always tricky due to capital needs and regulation.
Elon Musk is the outlier there historically.
Right, and Anduril mentioned as maybe a newer data point showing you can navigate defense contracting, but it's still really hard.
Okay, so let's try to synthesize. All these forces, capital flood, zombie overhang, stalled exits, LP pressure, AI boom, private liquidity, if they continue like this for, say, the next 5 years. What's the outlook?
The perspective shared was that the current system feels, well, problematic. It seems self-reinforcing. Less liquidity, maybe less focus on traditional company building, more high-burn strategies.
And without an external catalyst, maybe from the LPs needing cash.
It might just keep operating this way. And the math for hitting those historical VC returns looks genuinely tough in this environment.
Sounds challenging. Is there any silver lining if things did correct, if there was a reset?
Well, it would feel awful for many in the moment, no doubt. But the argument was that a correction could actually lead to a healthier VC environment long term.
Fewer opportunists, more focus on fundamentals.
Exactly. More authentic company building conversations. Gurley even mentioned finding the GP job more fulfilling during past resets than during the mania phases.
But AI might change that. The conviction is so strong.
That's the counterpoint. The belief in AI is so powerful and the capital weighting is so vast that even a downturn might rebound relatively quickly this time.
It's definitely a complex, unique moment. Understanding these dynamics, how they interact, it gives you a much clearer lens on what's happening.
It really does. Entrepreneurs, investors, LPs, everyone's navigating some pretty uncharted waters right now.
So maybe final thought for everyone listening to chew on. Given these powerful incentives, we've talked about keeping great companies private longer, using private liquidity to hoard that growth, delaying traditional market scrutiny. How sustainable is this whole evolving system?
Yeah.
And what might be the unintended consequences down the road if a major correction doesn't happen to kind of realign things?
Yeah, definitely a lot to think about there.